In the spring of 2000, a woman sitting in a suburb of Massachusetts opened a brokerage statement and read a number she could not fully process. Her Sycamore Network stock options, the ones she'd accepted instead of a higher salary, the ones that had seemed like a gamble when she took them, were worth, on paper, just over $1 billion. She was not a founder. She was not a household name. She was a mid-level network engineer who had joined a promising startup and worked long hours for modest pay, betting her future on equity. She was 34 years old. She was, briefly, a billionaire, and she could not touch a single dollar of it. That is where this story begins. Not with lavish spending, not with recklessness, not with fraud. With a number on a page that the law would not let her convert into anything real, and a tax bill that would consume her life before the decade was out. To understand what happened to her, and to dozens of people just like her, you have to go back to 1999. Not to some abstract version of the dot-com boom you've read about in retrospect, but to the specific, electric, almost hallucinatory atmosphere of a fiber optic startup in Chelmsford, Massachusetts, that was about to become one of the most spectacular financial events in the history of American markets. Sycamore Networks was founded in 1998 by two engineers, Desh Deshpande and Daniel Smith. Deshpande already had one legendary exit behind him, Cascade Communications, a networking company that Ascend acquired in 1997 for over $700 million. He knew how to build, he knew how to sell. And in 1998, the entire global telecommunications industry was desperate for exactly what Sycamore was promising: intelligent optical networking hardware. The internet was expanding at a pace that scared carriers. They needed to move data faster, more efficiently, across fiber lines that were rapidly becoming the arteries of modern commerce. Sycamore was building the switches that could do it. The company attracted serious investors, serious engineers, and serious momentum. People left stable careers at Cisco, at Lucent, at Bay Networks to join it. Some took pay cuts. Almost all of them accepted stock options as a centerpiece of their compensation, the standard arrangement of the era, the deal that said, yes, the salary is lower, but if this works, you'll never have to work for money again. Geezer and Orzo, the names used to describe the early founders and key technical architects, built a culture around that promise. Smart people, hard work, shared upside. It was not cynical. It was, by most accounts, genuine. These were engineers who believed in the product. The options were not a gimmick. They were meant to be the reward at the end of a difficult road. On October 22, 1999, that road appeared to end in triumph. Sycamore Networks went public on the NASDAQ. The IPO was priced at $38 per share. By the end of the first day of trading, it closed at $184. That is not a typo. A single day, 480% above the offering price. The company, which had been operating for barely a year, which had a handful of customers and a product still being refined, was suddenly valued at more than $15 billion. For the founders, the numbers were staggering. For early employees, they were surreal. For our engineer in Massachusetts, the woman who had negotiated her options carefully and watched the share count like a second heartbeat, they were transformative. At Sycamore's peak, the stock would eventually reach nearly $150 per share in early 2000, with intraday highs pushing even further. Her vested and unvested options represented a paper fortune exceeding $1 billion. She was not alone. Across the company, dozens of employees found themselves holding options that made them millionaires, multimillionaires, or in a handful of cases, paper billionaires. The offices in Chelmsford were, for a window of weeks, home to some of the most unlikely wealth in American history. And almost none of them could sell a share. This is where the story pivots from euphoria to trap, quietly, bureaucratically, lethally. When a company goes public, the SEC mandates what is called a lockup period. Standard duration, 180 days. The logic is sensible enough. Insiders and employees shouldn't be able to dump their shares the moment an IPO peaks and leave retail investors holding the bag. The rule protects market integrity. It is, in most circumstances, reasonable. In 1999 and 2000, it was a trapdoor. Sycamore's lockup period ran until late April 2000. The stock began its collapse in March. By the time the lockup lifted, the share price had already fallen by more than 40% from its peak. Employees watched the numbers slide. Some held, believing in the company, believing the dip was temporary. Others rushed to sell the moment their lockup expired, only to find that the spread between their mental wealth and their actual proceeds was already enormous. And some, the ones with the largest option grants, the ones whose sales would take weeks or months to execute, the ones whose financial advisors told them to be measured, to not panic, to trust the fundamentals, held longer than they should have. Our engineer held, and the stock kept falling. By the end of 2000, Sycamore was trading below $10. By 2002, it would touch $2. The company had lost more than 97% of its peak market capitalization. $15 billion of paper value had effectively ceased to exist. But here is the mechanism that converted a financial disappointment into a human catastrophe. It is called the Alternative Minimum Tax, the AMT, and in the context of employee stock options in 2000, it functioned less like a tax code provision and more like a financial guillotine. Under the AMT rules in effect at the time, when an employee exercised incentive stock options, ISOs, the standard vehicle for startup equity, they owed tax not on what they sold the stock for, but on the difference between the exercise price and the fair market value at the time of exercise. The phantom gain. The number on paper that existed because the market said it did, not because any cash had changed hands. Many Sycamore employees had exercised their options in 1999 at or near the peak. They did so for legitimate reasons, to start the capital gains clock ticking, to potentially qualify for lower long-term tax rates. Their financial advisors told them to. The tax code encouraged it. They held the shares, paid a nominal exercise price, and waited for the lockup to lift. What they did not fully reckon with, what almost no one in the popular imagination of the dot-com boom had reckoned with, was that the IRS would demand AMT on the paper gain at the moment of exercise, regardless of whether they ever sold the stock, regardless of whether the stock was worth anything by the time the tax bill arrived. Our engineer exercised her options in 1999 when Sycamore was trading near its peak. The spread between her exercise price and the market price at exercise was enormous. Under the AMT calculation, that spread was treated as taxable income. The bill that arrived was approximately $80 million. The stock she held to pay it was worth a fraction of that. In some calculations, depending on when she tried to liquidate, what the share price was that week, what the volume allowed, her entire remaining equity position would not have covered the tax. She owed $80 million on a gain she had never received, from a fortune she had never spent, derived from a company whose stock was now nearly worthless. She was not the only one. Across the community of Sycamore employees, the pattern repeated with brutal consistency. A software architect here, a hardware engineer there, people who had made responsible decisions, who had followed their accountant's advice, who had done exactly what the system told them to do, and who were now technically insolvent, facing tax liabilities that dwarfed whatever assets they could liquidate. Some of them declared bankruptcy. Some negotiated payment plans with the IRS that would stretch across years, consuming income they hadn't yet earned from jobs they hadn't yet found. Some sold their homes. The IRS, to its credit in some cases, offered installment arrangements, but those arrangements assumed future earning capacity that wasn't guaranteed in an economy where the tech sector was shedding jobs at scale. The human cost was not abstract. These were people in their 30s who had deferred normal financial life, saving slowly, buying conservatively, building incrementally, because they believed the options would take care of everything. They had, in many cases, structured their entire financial identity around a number that no longer existed. And the government wanted $80 million from money that no longer existed. There is a specific cruelty to the AMT trap that is worth dwelling on because it is not the cruelty of individual failure. Nobody gambled recklessly here. Nobody built a lifestyle on borrowed money. Nobody acquired a yacht or a private jet or a Monet on margin. The mistake, if you call it that, was trusting that the numbers on the paper were real, that the law would not force you to pay tax on air. The mistake was legal, structural, and in many ways unavoidable, because the AMT provision as written did not account for the possibility that paper gains could evaporate before they were realized. Congress would eventually acknowledge this. In 2008, the AMT relief provisions for ISO holders were amended to provide some retroactive relief. The IRS issued guidance. Some former Sycamore employees were able to reduce or restructure their tax liabilities, but by then, for many of them, the damage had already been done. Bankruptcies had been filed, credit had been destroyed, careers had been rebuilt from rubble. The relief arrived like a pardon after the sentence had already been served. Sycamore Networks itself did not die. It survived, in a diminished form, for years, a hollowed-out version of the company that had briefly been worth $15 billion. The founders fared better than most employees, not because they were wiser or luckier, but because their ownership structure gave them more flexibility, more advisors, more time. Some sold portions of their holdings before the peak. Some diversified. The specific financial outcomes of Despand and Smith are not fully public, but both have remained active in business and philanthropy. Despand, in particular, has been a significant figure in the Boston entrepreneurial ecosystem for decades. For the mid-level employees, the ordinary believers who took the bet and lost the decade, the story is quieter and harder to trace. Many of them rebuilt. Some went back into tech. Some left the industry entirely. Some, according to people who knew them, still carry the psychological residue of having been, briefly, paper billionaires, of having held a number in their hands that felt like a future and watched it dissolve. Our engineer, the woman with the billion-dollar options and the $80 million tax bill, navigated a decade of financial reconstruction that is difficult to summarize in a sentence. What can be said is that she survived it. The IRS does not make exceptions for people who did nothing wrong. It makes payment arrangements, which is not the same thing. What her story illustrates, at its core, is a collision between two systems that were never designed to interact. A tax code written for a world of normal salary income, adapted imperfectly for equity compensation, then stress-tested by a market event no one had modeled. And a group of ordinary to exceptional people caught at exactly the intersection where those systems failed. The dot-com boom produced many cautionary tales, tales of fraud, of delusion, of executives who cashed out while retail investors burned. But the Sycamore story is different and harder. It is a cautionary tale in which no one was obviously fraudulent. The company was real. The technology was real. The ambition was real. The wealth was, for a moment, real, or at least as real as a market says it is. What destroyed people was not their greed, but their timing, the lockup they couldn't control, and a tax provision that treated potential income as actual income, regardless of whether it ever materialized. The alternative minimum tax, in this context, was not the villain in the cartoon sense. It was a law designed for a different purpose, applied to a situation its architects never imagined, and it cost people everything. In 2001, a congressional hearing touched on the AMT and stock options crisis. Witnesses described their situations. Legislators expressed concern. Nothing moved quickly enough to matter to the people who needed it then. The number $1 billion is so large it becomes abstract, but $80 million owed to the government on a stock position worth perhaps $3 million at current prices is not abstract. That is a specific terror. That is a specific morning when the phone rings and the number on the screen is not your broker. That is what it cost to have been, briefly, a paper billionaire in the winter of 1999. Whatever you think you know about the dot-com crash, the irrational exuberance, the Petscom sock puppet, the Nasdaq chart that fell like a stone, there is a layer underneath the spectacle that rarely makes headlines. It is the layer where people who did nothing wrong lost everything they thought they had at the intersection of bad timing, impenetrable tax code, and a market that moved faster than any law could follow. That story is worth sitting with. It does not resolve cleanly. It does not offer a satisfying villain or a redemptive arc. It offers something rarer and more useful, a clear-eyed look at how catastrophic loss can arrive not through recklessness, but through the precise, documented, legally mandated operation of systems working exactly as designed.